I happen to actually have some money with me today, which is unusual, okay? I usually don't have much money in my pockets. Our money, I should have brought in, I have a collection of money from other countries, because I travel, you know, I used to travel, as you gathered, for my corporations that I worked for. And you can't help but end up with some, you know, you just can't convert it all, right? When you get to the airport and you find out you've got, you know, some of that, what I call it, monopoly money, right, in your pocket, and they won't take it at the foreign exchange counter, right, because it's too small. The fee that they would charge you would basically use it all up, right? So I end up with all kinds of bills and coins. And our money is kind of boring compared to most money in the world, right? It's just this green and a pale green color. Most money is really, really nice looking, right? It's beautiful, different colors, nice portraits, whatever, right? But they all have one thing in common. What they have in common? In and of themselves, they're worthless, okay? Its intrinsic value of this piece of paper is practically zero, right? It has no value in and of itself as an item just as it is. Not what it represents, but what it is, right? Why would we accept these basically worthless pieces of paper in exchange for goods and services? Why would we accept them? Okay. It is not backed by gold, okay? It used to be, okay? At one point in time, up until roughly in between World War II and 1971, the value of major currencies, all major currencies, was tied actually to the U.S. dollar. And the U.S. dollar the value of that was defined in terms of gold, okay? So U.S. dollars could be, it turned into gold, all right, only up until 1971. And the reason being, up until in the late 1960s and early 1970s, we began to run huge trade deficits, meaning we were exporting far less than we were importing. So all kinds of dollars were flowing out of the United States. And foreign countries would take those dollars and they would use them to buy gold, okay? So we were seeing all of our gold flowing out of the country. So our president at the time, Tricky Dick Nixon, not a crook. He was a crook, okay? It's amazing how time rehabilitates people, right? That he's, there's many people a hero, but to my generation, terrible. I didn't end up in the war, luckily. You know why? I was a draft age, 18. Could have been drafted and gone to Vietnam, right? Or actually could have been drafted and gone to Canada. That's probably what I would have done. But my number was too high, right? I was like 280, and they only got up to 180. So, but at any rate, Nixon removed that link between gold and the value of currency, okay? And the idea was to maintain stable currency values. The reason being is that during the Great Depression, nations would devalue their currencies, drop the value of their currency, okay, in order to make their exports cheaper, like we talked about. Because we're in a Great Depression, the United States figured, hey, they did two things, all right, two things. They put up barriers to imports, and they began to devalue their currencies to make their exports cheaper, all right? And what happened was they went through these cycles, rounds of devaluations, where each country, you know, the United States values its currency. I'm not sure really exactly how it worked, but we make the value of our currency goes down, so our goods become cheaper. And what do the English do? The English go, hey, yeah, that's not fair. Now we're not exporting anything, and we're importing all this stuff from you guys. We're going to devalue our currency. And then the French said, hey, you're going to do that, we're going to do that. And then the Japanese said, oh, you're going to do that, we're going to do that. And then the Americans said, hey, now we're back in the same position. We're going to do it again. Okay? And this went round and round and round. And what happened was all the value of your money was plummeting. Okay? The war intervened, and at the end of the war, the nations that were going to soon be the victors in the war got together and said, you know, we got to do something to prevent this from happening again. So they tried to set up a fixed system where the value of currency was fixed to the dollar, which was in turn defined in terms of gold. But that system got blown up in the early 1970s, okay? We were also seeing huge amounts of inflation coming then, thanks to the war, spending tons and tons of money. And this is another important thing about the chapters we're going to go on, right? That when the government increases the money supply faster than the output of goods and services, we tend to get inflation. So two things were going on. President Johnson created what's called a program called the Great Society, which was a massive social spending program, okay, where the government attempted to spend our way out of poverty, lift people out of poverty by spending money, and at the same time, spending tons of money on the war, okay. So we had all kinds of issues at that time, but money is no longer backed by anything, okay. This is not tied to. So why do we accept it? We have a social contract, first off, okay? We have an agreement amongst ourselves that this represents value. It has worked in the past in terms of being able to use it for exchange of goods and in exchange for goods and services, and there's no reason to believe that it won't continue to work in the future. So we have an agreement amongst ourselves that this represents value. And that we have confidence that it will continue to represent value into the future, okay? And as we know, because of inflation, the value actually goes down every year, but nevertheless, we're willing to hold some money. There's another reason why we use this for goods and services, okay? By the way, the alternative, barter, we talk about that? Very inefficient way, right? Because in order for an exchange to take place, you have to have something I want and I have to have something you want. Okay, but when we have currency, cash, on one side of the equation, there's always an immediate, what they call coincidence of wants. You have something I want, I've got something you want, money, okay? Right? But there's another reason. I have to put my glasses on. Actually, I don't have to put it on. I know what it says by heart. It says right on here, okay? This note is legal tender for all debts, public and private, meaning you have to accept money. This is called fiat money, F-I-A-T, fiat money. You are ordered by the government to use this, okay? This is true. You don't have to accept other goods in exchange for goods. You don't have to accept checks. You don't have to accept credit cards, but you have to accept cash, okay? It is legal tender, all right? So two reasons. We have a social contract, and we are ordered to use it by the government, all right? And this is true for most countries, okay? I should have brought my, too bad, I'm going to put that away. All right, I might need it later, okay? Buy my train ticket. Okay?
So the expense in the war is the government expense?
Sure, oh yeah. Yeah, well, we're not buying tanks, right? But the government is. By the way, the government spends money on all kinds of things that we don't need, right? There's a huge program to build tanks here in the United States, right? Where they're going to build all kinds of these really, $50 million each tanks or more than that, right? Huh? Army doesn't even want them. They've got all kinds of tanks sitting out in the desert that they're not even using, right? But the Congress insists on spending this money. Okay? This is one of the other major problems with fiscal policy, by the way, is that politically powerful people get the government to fund projects, to pay for projects in their area that really aren't necessary. Okay? You remember Sarah Palin? Okay? Hopefully we can forget her soon. But they were going to build a bridge, okay, from her part of town to an island, and it was going to cost like $20 million, and there were only 8 people on the island. Yeah, exactly. We don't want to spend the money, okay, to bring money into my town. Look what I did. I brought $50 million into town, okay? Re-elect me for another year, right? Just before I quit. I know, she didn't even last. So what did she do? A year and a half as governor, right? And that was it? Fox News paid her way more. Yeah, she quit there too. She's coming back though, isn't it? I'm sorry, Young?
But at least that can increase the GDP of that town.
Yes, that's true. It would, but it's unnecessary, right? And who's paying for it? We are, right? We have to pay for those things, okay? Now, is money the root of all evil? The desire for money might be, right? Pretty much, but not necessarily, right? We need to use money, But cash, when we talk about money, really what we're talking about, there's actually different measures of money, as you probably already should know, okay? We have what's called M1, money measurement 1, and money measurement 2. There used to be M3 also, but I don't know what happened to it, okay? And the difference between these two measurements of money has to do with liquidity, okay? Liquidity, how easily is this item, asset, turned into a medium of exchange, something that can be used to acquire other goods and services, okay? And in fact, money, out of all possible assets, money, cash, is the most liquid of assets. It has no transaction costs, meaning you don't incur any cost, it doesn't cost you anything, and there's no time frame to convert it into something that can be used for other goods and to buy other goods and services, right? Because it is the medium of exchange. But if you have land and you want to use that to buy something, you've got to sell it. It's going to take you some time. It's going to cost you some money, okay? So these measurements have really to do with this is the most liquid assets, okay? And these are those plus less liquid, meaning the things that are in M2 but not in M1 would take you some time and cost you some money in order to convert them into something that you can use, money, to buy something else. Does that make sense? Maybe, okay? So the first thing we have is currency. Okay, bills and coins. Okay? Some nations don't use coins, you know? Does anybody come from a country where they don't use any metal? Yeah, okay. In Russia and India and Pakistan, they don't use any metal coins at all. The lowest in Pakistan, the lowest denomination, lowest number is a 1 rupee note, right? And that's worth, I don't know, 5 cents, okay? But they don't have any metal coins at all. I think we should get rid of the penny, don't you? Yeah. It's worthless. In fact, it costs more to make it than it's worth, right? And that's true a lot. But currency, bills, and coins. The book calls them transaction deposits, but more frequently you would probably see them as demand deposits. In fact, I may use that term a lot because that's the one I'm used to. Good morning, Diane. Okay. And what these are deposits. The reason why they're called demand deposits, they're deposits, your deposits in your checking account, okay? Which will be taken out on demand. When you write an order to the bank that says give this person $100, the bank will honor that. It's when it's presented on demand, okay? So these are essentially the same as cash, pretty much, all right? And then finally, the last piece are traveler's checks. Okay? Those are considered nearly the same as cash. Does anybody ever use a traveler's check? No? Yeah, very few people do today. I used to use them all the time, and they were kind of funny. They look like a check, okay? Right? And it would be who you made it out to, and it would be a certain value, say $50. And there would be a line up here where when you get them, you sign your name, and then there's another line over here that when you try to use them as cash, you had to sign them again, okay? So that the customer could see, yeah, you own this, all right? And if you brought them back and you had to turn them into the bank, not only had to be signed twice here, but you had to flip it over and sign it again. I had a big argument with the bank teller. I was like, that's ridiculous. I've signed this thing twice. What do I need to sign it for 3 times for? They're stupid. Right? I guess that's the rule. Yeah, sure it is. Okay.
What people still use it since there's a credit card?
Yeah, very few. Okay, very few people use them when they travel. You don't really need to. You can bring your debit card and get money usually right out of an ATM. Now, we use money as a medium of exchange, right? The most liquid of assets, the easiest to turn into other goods and services. So if I intend to buy something, okay? Now today, we use debit cards a lot, right? These function, as far as we're concerned, the same. It's electronic, what they might call electronic payments, okay? But they essentially function the same way as cash. You can't use your debit card if you don't have any money in your checking account, right? So you have to have transaction deposits. This is just a different way of doing that, all right? Okay? Now, so we need to have some money if we're going to buy something. This is called the transaction demand for money. Now, if we want to buy a lot of things, then we want to have a lot of cash, or at least we want to have money in our checking account so that we can use our debit cards, right? Or write a check, doesn't matter, okay? But if I come to school, I know I'm going to be, when I leave here, I'm going to go to the train station, okay? And I'm going to buy a piece of pizza from Crazy Dough's. And then I'm going to take that piece of pizza over to the bar, and I'm going to have a beer with it, right? And I'm going to pay cash. If I know that a piece of pizza is going to cost me $5, and a beer is going to cost me another $5, do I just make sure I only have $10 in my pocket? No, because maybe I'll be really hungry or really thirsty, right? And I might decide I want another one. So in addition to having a certain amount of cash for transactions purposes, we also want to have a little bit extra, just in case, okay? This is called a precautionary demand for money. Now, the other reason we like to have cash, and I'm talking about mainly M1. Oh, I never get to M2, did I? I just did M1 and that was it, okay? M1, cash, currency, demand deposits, and traveler's checks, okay? And M2 includes all of these, okay? Plus some less liquid measures of money. Savings accounts, okay? Because you can't just write checks on these. It's less liquid. Right? Typically, there are restrictions, but not always. But savings accounts, I'm sorry, that would be M3. Small, what they call small denomination time deposits. Are you familiar with CDs? Certificates of deposit, okay? It's a bond. A CD is a bond. You lend money to the bank, and the bank agrees to pay you interest on that money when it matures. The way this bond works is that the bank gives you your money back plus whatever interest you earned, okay? And there's a penalty. If it's a small denomination time deposit, if it's less than $100,000, if it's more than $100,000, it's called a large denomination time deposit, okay? And what was the third thing? I can't remember. Oh yeah, money market mutual funds. Are you familiar with mutual funds at all? When you invest, okay? Yes, that's exactly right. Okay. When you invest, you don't want to put all of your money into one company, right? Because if that company does badly, you lose your money, all right? So the idea, in order to reduce your risk of loss, you want to have investments in as many different companies and industries as possible, all right? However, if you're just a typical person, you don't have enough money to buy a wide enough range of stocks and bonds and other financial instruments to reduce your risk enough, okay? You don't have enough money. That $2,000 you have to invest, you're going to buy 10 shares of IBM or whatever, okay? Not even. Right? Okay? And that's not going to, you need to be diversified in order to reduce your risk. So what small investors can do is pool their money, add it to other people's money through a mutual fund, okay? And the mutual fund will pool everybody's money, and they will invest it in a wide range of different kinds of securities. They will diversify it for you. That's why mutual funds are very attractive for small investors. They pool the money of a wide number of investors and buy a wide range of diversified securities in order to reduce the risk for everybody, okay? But you can't just write checks on it. It's not as liquid as your checking account. You can write checks on it, but you can only write, they have a minimum amount, typical $1,000, and you can't write more than 1 or 2 or 3 or whatever in a particular period, a month or two, all right? Okay? So that's M2. We don't, personally, the M2 doesn't mean much to us, right? I actually have some money in my savings account, but I don't keep much money in my savings account, typically $5. That's it, right? Why? It doesn't pay any interest, okay? So I have most of, or very little. So I have most of my cash, what little I have, in my checking account, okay? Because to me, it's more important that the money is liquid, right? Although it's so easy to just transfer it from my savings account to to my checking account today. It's just, yeah, I know. So, now, whether or not we want to, now, how much cash do we need? Okay. Well, I don't think the book talks about this, but how much cash we need is a function to a large extent of our nominal GDP, right? That if GDP rises, and it can rise for two reasons, higher prices or more output, we need more cash to buy that higher amount of GDP, okay? So typically, as GDP rises, we need more cash to buy that greater amount of GDP. But how much cash or currency we're willing to hold, to a great extent, is dependent upon interest rates, right? That if interest rates on other possible assets, bonds, other investments is high, where the opportunity cost of holding cash is great, right? But if interest rates are really low, like they are today, if interest rates are 1%, okay, if I have my money in cash, am I going to lose much over the course of the year? No. If I have $1,000, I'm going to lose $10. All right, big deal. But if interest rates are 10%, now I might say I want to keep as much in cash as little as possible, because I'm giving up the opportunity to make money, okay? So the demand curve to hold cash is a downward sloping curve, and it's a function of interest rates, okay? When interest rates are low, we don't mind holding a lot of cash because we're not giving up anything. But when they're high, we don't want to hold a lot of cash, okay? Now, we do hold some of our wealth, no matter what. Some of that store of value that we accumulate over our lives, okay? We hold some of that wealth in the form of cash because it is the most liquid of assets, with the easiest and cheapest to turn into other goods and services, okay? So I don't want to put all my money into stocks or real estate or jewelry, because if I want to buy something else, it's going to take me some time and cost me some money to convert that into cash, okay? So the transaction costs that we have to bear also determine how much of our wealth we want to have in the form of cash, okay? All right, does that make sense? But as interest rates rise, the opportunity cost of holding cash increases, so we tend to reduce our cash balances, okay? So far, so good? Okay. I would like to have some cash balances. My wife this morning they want her at both companies that she works for, they want her to pick up more hours. They want her to work on Saturdays or part of the day Saturday. And I'm like, how do you mind? You're working enough, right? And she says, well, maybe instead I'll work during my lunches during the week. And I was like, what are you talking about? You know, well, I want to make some more money. And I was like, you're already working at plenty, okay? The real thing is, I'm feeling guilty, right? I don't want her working more than 40 hours a week when I'm only working 10. All right. So anyway, she's like the Energizer Bunny, telling you, she just goes and goes and goes. It's amazing. It really is amazing to me. You know, she works all day long, then she comes home and does stuff that I should have done. I'm busy. I got to play with the dogs. All right. Now, why do we, okay, so we have money as a medium of exchange, a unit of account. Okay, money also functions as a unit of account. Now, what it has to, first off, let's step back a little bit. What has to be true to be considered money? Okay, there's only one thing that has to be true. It has to be generally accepted by everybody in exchange for goods and services, okay? Anything that is generally acceptable in exchange for goods and services is money. In the modern world, it's currency, but it hasn't always been that, right? Modern currency really didn't have its origins until the 1600s, all right? I mean, there were previous kinds of things. You know how money got its start? People with gold, depositing them in safe places, would get a receipt for that gold, okay, that says you've got so much gold on deposit here. And you could use that, you know, I've got, it says here I've got, you know, $500 worth of gold on deposit here. I tell you what, that's $450. I'll give you this $500 note, $500 claim for that, and you can go get the gold, okay, in exchange. And that's how money actually got its beginnings. Here in the United States, when did we get it? Do you know when we got a national currency? Okay. 1865. Okay. Before that, every state would issue its own currency. The banks in their state would issue their own money. Okay. But there was all kinds of problems with that. Right. One of the biggest problems was, let's say the bank here in Boston issued some notes. You know, you went and you put your gold into the bank, and the bank would give you a note, all right, that says it's worth such and such, all right? Or you put your money in there, and the bank would give you a receipt. And you could use that receipt to trade for goods and services. The problem was, the farther and farther you got away from that bank, the more and more worthless that note became. Because in those days, people couldn't take the train or fly, right, or drive. They had to travel by cart or by horse or walk. So you went down to New York, people were going to say, I'm not going to accept this on some bank in Boston. I'd have to take me 3 days to 4 days to get to Boston to claim it. So the farther away you got, the more worthless it became. And there are other issues in the banking system too. We used to get these bank panics. Up until the creation of the Federal Reserve Bank of the United States in 1913, if you were worried about your bank, okay, and this is the way typically something would happen. A very large company that you know does business with your bank, okay, fails. It goes out of business. It goes bankrupt. And it happens to owe that bank a lot of money, okay? And you know that because they didn't pay back that loan, that bank's not going to have sufficient income to stay afloat, to stay what they call solvent, and it's probably going to fail. And if it fails, you're going to lose your money, okay? You won't be able to get it. So what do? If you hear that this company is going to fail, or you think it's likely, you run down to the bank, okay? Everybody runs down to the bank and asks for their money back. And what happens to the bank? It goes under, okay? And it wasn't until the creation of deposit insurance that they were able to, that's managed through or overseen by the Federal Reserve Bank of the United States, that we don't worry about bank panics anymore, right? If the bank goes out of business, we'll still get our money back. In the 1980s, my bank failed, okay? The Savings and Loans Bank here in the United States, which was set up primarily to pool the resources of the community in order to make loans to people to buy houses, okay? They were so unregulated that they made so many bad loans, and this happened for many, many banks, that they went out of business. And my bank was a savings and loan, and it went out of business. But the government, I didn't worry about it, and most people didn't either, because the government stepped in and they covered our deposits. We were able to get our money back. In fact, it cost taxpayers in the United States in 1981, 82, 83 timeframe, I think $280 billion to bail out the savings and loan banks, okay? So that was another problem that we used to have that we don't have anymore. The federal government made it impossible for banks to issue their own currency in 1865. What they did is they taxed. They put a tax on any banknote issued by a private bank, okay? And that basically put them out of business. What they were trying to actually do is put all of the state banks out of business, okay? But the state banks said, oh, we can't use this money anymore? We'll use yours. Okay, and they were able to stay in business. Now, did you notice by any chance how many banks the United States has? Did you read that chapter? Oh, I think it's something like 12 to 13,000, something like that. Okay, 8,000 credit unions. Okay, now. It should go down every single year. And the reason why we have so many banks is that we used to have a very fragmented banking system. We had rules that prevented banks from doing business outside their communities or outside, or at the most, outside of their states. So they didn't have any competition. If you wanted to do business with a bank, it had to be a local bank or a bank in the state. Okay? So we couldn't do business in Maine if we were a Massachusetts bank. They changed all that And the number of banks has been shrinking as banks merge together, less efficient banks fall to the competition and the like. But a place like Canada with one-tenth the population of the United States has about 1% of the banks that we have. Japan is the same way. Very few banks. Okay? Europe, the same way. Only 3 or 4 banks, 5 banks in any country. Okay? Where we have thousands of banks. But that's changing. Illness?
Isn't what happened with Donald Trump during the last recession? Because he was going out of business, but that would make so many banks going out of business, so they tried to save him.
Yes. Well, that of course happened during the great financial crisis here in this country, that the Federal Reserve had to step in and pump all kinds of money into all kinds of companies because the domino effect, basically, right? One big one goes down, it drags a whole mess of other financial institutions with it. So we had to prop them all up. And I don't remember about Trump. They should have let Trump go down the tubes. This business, money as a standard of deferred payment. Okay, if you buy that, this means this is a medium that you'll have to pay debts for in the future. That doesn't sound like any different than money as a unit of accounting. Oh, I didn't even talk about that. As a store of value or of a medium of exchange, all right? As a unit of accounting, we use money so that we can express the value of any good and service in terms of a certain quantity of money. And what that does, that allows us to compare values of different goods, okay? So we use it as an accounting standard. All goods can be expressed in terms of a certain number of dollars or whatever foreign currency there is, okay? Oh, I was going to say something else. What was it? It'll come back to me. Maybe I'll figure it out as I go through. Oh, yeah. Currency today, to be valuable or useful, currency today has to have certain features. It's one of the reasons why we do use this instead of what they call commodity monies. Now, commodity monies are, remember, anything that can be used in exchange for goods and service is money. Okay? And in the past, until we had these types of things, bills and coins, we used commodity money. And what that means is these things represented value. However, in and of themselves, they were useful. You could do things with them, in particular, gold and silver, right? You could make nice jewelry. All right? Okay. Now, but today, and in different places, they used, like in Papua New Guinea, the money there in more primitive times, earlier times, was pigs. Okay, they used pigs. So there's some problems with using commodity monies, though, in particular animals, right? First off, to be really useful, money needs to be portable, easily carried from one place to another, all right? A pig is heavy. Okay? Yeah, that's another thing. It has to be durable. It has to last. You can't worry that if I give you this today, something will happen to it tomorrow. It'll get sick and die, right? Not only that, but it is standardized. If I say this land's going to cost 5 pigs, maybe you'll bring 5 little pigs. Maybe you'll bring 5 sick pigs. Maybe you'll bring 5 real old pigs. Okay? I don't know. All right? It has to be portable, durable, easily broken down into smaller units. Okay? You can't divide up this land's 2.5 pigs. All right? So there are some features of currency that make it far more useful as a medium of exchange, as money. Than commodity monies. Okay, it's becoming. Do you know it's illegal to make a copy of this? That if you took it down to the copier and made a copy of it, both sides, you could be arrested. Yeah, you could be arrested. If you make a copy of it, it either has to be either twice the size or half the size, something like that. Right? People make. They're becoming harder and harder. I mean. With the modern technology, right, in order to prevent counterfeiting, they've had to become more and more innovative and difficult to holograms and lines and all kinds of things. So. I'll never forget the first time I saw a $100 bill. My dad went into the bank and he came out and said, "Look at this." And he showed me $500 bills. I was like, wow. In 1957. All right. All right, so the money, the most liquid of assets, okay? And again, money standards, what backs money? Our agreement. That's it, okay? The transaction approach to measuring money, M1, currency, coins and bills, transaction deposits or demand deposits in what they call depository institutions. What's another name for a depository institution? A bank, okay? It's a bank. You make a deposit, right? And then traveler's checks. Okay? And then M2, savings deposit, small denomination. Yeah, I could use some small denominations, 100,000. Money market mutual funds, all right? I don't care about the rest of that too much. Now, this financial intermediation in banks, I don't really care about that at all, okay? Banks are financial intermediaries. What does that mean? Most financing, I might as well tell you what it means as long as it's in there, okay? Most financing that we engage in when we want to borrow money is indirect, meaning you put your savings into the bank and then I go to the bank and borrow it, all right? We don't lend money directly. Financing is not direct. Why? It's too risky, okay? I don't know you. I don't know whether you're going to pay me back or not, okay? So I'm not going to take the risk. You could be my brother. I lend you the money, I'll never get it back, okay? All right? People are much worse, much less able to sort out good risks from bad than banks are. Banks are equipped, right, to sort out good risks from bad. They're able to gather information. They have tools to use to determine good risks from bad, right? They look at your credit rating, your credit report, right? Anybody have a credit report? Anybody check your credit report, credit rating lately? Yeah? How's it good? Good? Excellent. What's the best you can get? Is it 900 or is it 850? 850, I think, okay? Last year at this time, I was about 640, okay? But now I'm at about 760. Huh?
760 is very good.
Yeah, it's very good. Should be. I paid off, I told you, did I tell you? Yeah, I paid off $100,000 in debt last year. Yeah. I think 750 was the highest then, yeah, okay. So banks are able to sort out good risks from bad. As this talks about, there are two major issues that lenders face. First one's called moral hazard, okay? Now, the first one's called adverse selection. What does that mean? Do rich people with tons of cash, tons of money, do they need to go to the bank and borrow money? No. Do people who are really desperate or are going to go down the tubes in a hurry pretty soon, are they the ones who are more likely to show up at the bank and borrow money? Which one would you lend to? Okay? Banks only lend to people who don't need the money. All right? This is the problem, that the people most likely to come to the bank and want to borrow money are the people that you should probably not lend to. All right? That's the first problem. So bank has to sort out good risks from bad. The second problem is called moral hazard, and that's what's going to happen once they do lend you the money. Both problems arise from something called asymmetric information, meaning the borrower has way more information about their true situation and their intentions than does the bank, okay? So asymmetric information means that you have a hard time sorting out good risks from bad because most of the people that want to borrow money are bad risks, okay? And you have to be sure that once you lend them the money that they're going to use it for the purpose that they said they were going to use it for. I need $100,000 to buy inventory for my company so that I can sell more and stay in business. You get the loan, and what do you say? Well, I got $100,000. I think I'll go down to Foxwoods. All right? Or, I got $100,000. I think we'll go buy a new car, and then I'll use the rest. All right? It might take actions that would result in it being less likely you're going to pay that money back. So the banks are financial intermediaries because we, as individuals, have a much harder time determining whether or not you're a good risk, that you're going to be able to pay me back, and that once I do lend you the money, you're going to use it the way you say you're going to use it, okay? So most financing is indirect. You don't lend me the money directly. You put the money in the bank, and then the bank lends me the money, okay? That's indirect financing, okay? There is a lot of direct financing, though, okay? There is plenty of direct financing. Do you know how the stock market works? It is not. It is direct. It is only direct initially. Okay? What happens when a company wants to sell stock? Now, you're familiar with stock, shares in the company, ownership. When you buy stock, you're one of the many owners, all right? Okay? When the company wants to sell stock initially, they don't sell it to the public. They sell it to or through a private investment bank. And that bank calls up its best customers and says, I've got this really good sweet deal for you. Okay? Okay? And they sell their stock, they sell the stock to their best customers. It's only after, so that's direct finance. The bank or the customers provide money directly to the issuer of the stock. But once that stock's been sold once, if that investor wants to get rid of it now, wants to sell it, then it'll appear in the stock exchange, okay? NASDAQ or Amex or New York Stock Exchange, okay? So it's the stock market is the used stock market, right? It's the market for used stock. And that's not direct finance anymore. It's only direct finance when the company issues the stock and the investment bank buys it. Actually, what the investment bank does is guarantee a price for that stock, and then they try to sell it to their customers at a higher price, okay? That's direct finance. But the rest of it, most financing is indirect. Now, we have the Federal Reserve System. Okay. The Federal Reserve Bank of the United States, created in 1913 to bring order and stability to the American financial system. Matt?
The thing you were just saying about they sell their stock to the bank and then the bank does whatever, would that be preferred stock?
No, there are two different kinds of stock. Well, actually, two basic kinds of stock. One's called common and one's called preferred. Okay, and the difference between the two, when the corporation makes a profit, right? After they pay their corporate income taxes, as we all know, then they divide up whatever profit is left over amongst the common and preferred stockholders. But here's the deal. If you own common stock, you have the right to vote for the board of directors. I explained that to you, didn't I, last time? Not last time, but earlier, that corporations, the president of a corporation has bosses, and that's called the board of directors. People who have been elected, voted for by the shareholders, the stockholders, to oversee the management of the company. So if you're a big stockholder and you don't like the way the president is running things, you get your votes and you elect your guy for the board, and then your people are on the board and they fire the president and hire somebody else, okay? So plus that you get to vote on major issues facing the company. If you own common stock, you have the right to vote, but you get your dividend, your portion of the profits, only after the preferred shareholders have been paid, okay? It may be that there's no money left for you at all. If you own preferred stock, okay, you do not have the right to vote, but you get paid first. If there's any profit, you get your dividend, and the dividend is guaranteed a certain amount, okay? Whereas the common stockholders, their dividend could be big, it could be zero. Depends whether the corporation decides to pay one or if they can pay one or not, all right? So preferred stockholders, and if you don't get your dividend, if the corporation didn't make any money this year, and you're a preferred stockholder, and let's say they owe you $10 per share, next year, if they make a profit, you'll get $20 per share. That profit will roll over to that dividend will roll over to the next year. But if you're a common stockholder and we don't pay you any dividend this year, you ain't getting anything, okay? So it's much more risky, but you have more rights in terms of running the company, all right? That's the difference between preferred and common. Okay, you guys? Okay. Now, the Federal Reserve. Okay. The important piece of the Federal Reserve in terms of management is the Board of Governors, okay, which are 7 people, including the chairman of the board, Ben Bernanke. The other 6 members of the board come from the banking industry and from business community and from the community itself in terms of civic or community leaders, okay? because we want to have a balanced view. We want to have all major groups. We want to have the banking industry, we want to have business, and we want the community represented in the Federal Reserve Bank of the United States, all right? The other important piece is the Federal Open Market Committee, the FOMC. That consists of 12 members, the 7 people who are on the Board of Governors, and the Federal Reserve System is broken up into 12 regional banks. 5 of the regional bank presidents will be also on the FOMC, okay? So it's the 7 Board of Governors, 4 rotating amongst the banks, amongst the Fed banks, Fed regional banks, okay? And then I should put plus, or not plus, and plus the New York Fed Bank president, okay? He's always on it, all right? So the 7 people on the board of directors and 4 bank presidents from the 11 that aren't New York, that rotate, you know, Denver and Boston and Florida and Atlanta this year, and then next year San Francisco and whatever, okay? And the New York president is always there. The reason being is that the open market operations, which is the buying and selling of bonds, are conducted by the New York Bank. So the head of the New York Bank is always on the Federal Open Market Committee, okay? Not all that important, but these people decide whether or not the economy needs to be stimulated or calmed down or left alone, okay? Remember we said that monetary fiscal policy is made by 530-something people, okay? 12 people make monetary policy, and really most of them follow the direction, if not all of them, follow the direction of the chairman of the board, Ben Bernanke. Now, the people on the board of directors of the bank are elected by or appointed by the president and approved by Congress. The bank is meant to be independent of political influence. The idea is that in order to manage the country properly, financially, they can't be influenced by politicians, because we know what politicians do, right? They try to rig things for their favor, all right? So they're meant to be independent. For that reason, they are elected, they are appointed for 14-year terms, and they cannot be fired. And once their term is up, they cannot come back, okay? So they're meant to be, it doesn't matter, I'm here for 14 years, I don't have to worry about coming back, I can't, and you can't fire me, okay? So they're meant to be independent. Whether or not they're totally independent, probably not true. There's probably definitely some political influence on the board, but it's meant to be as independent as possible. By the way, do you know who the name of the last chairman of the board was? Greenspan, a guy named Alan Greenspan, okay? Who admitted he did a lousy job, okay? He was the chairman of the board for 18 years. How does that happen? Yeah. Well, he was elected, he was what happened? He was appointed chairman partway through his first term, so they made him chairman for 14 years, and he'd already been in Federal Reserve System for 4 already, I think, was the case, something like that, I can't remember. But he ended up with an 18-year tenure, which is unusual. And some people think he's great, and some people think not. He did a terrible job, and he says, I don't think he did. He says he didn't think he did a very good job, but, huh? Re-elect me, anything's better. Okay. What does the Fed do? Do we care? All right, it supplies the economy with money, currency, fiduciary currency. That doesn't mean it prints currency, right? Who makes the money? The Mint, the U.S. Mint, part of the Treasury Department, the U.S. Department of Treasury. Okay? They hold depository institutions' reserves. Banks are required, again, it's not a hard and fast rule, but we're going to make it simple on ourselves. Okay? Banks are required to hold on to 10% of all of their deposits. So if you put $1,000 in the bank, The bank has to hold on to $100. They can only lend out $900, all right? The reason being, let's say the next day you show up and you want to take some money out. The bank can't say, I'm sorry, I lent it to somebody. Right? Come back tomorrow. Right? So they have to have money available to lend out. Right? So they have to keep money on deposit at the Fed and or in their vault. Okay? When you go into the bank and you see the big safe there, what that gets robbed when they rob the bank, that's where they go to get the money. That's called vault cash, vault, V-A-U-L-T, all right? That's the vault. So they have to keep 10% of their deposits on reserve at the Federal Reserve and in their own vaults, cash on hand, all right? They act as the government's bank. Okay? They supervise banks, depository institutions. In fact, I think my brother worked for the Federal Reserve when he got out of college for about a year, and he was down in New York City, and he was a bank auditor. The Federal Reserve would send him in to look at banks, at their accounting practices and their records to make sure that they weren't doing too many risky things or playing by the rules. I used to do auditing too. Did I tell you that?
No.
Yeah. I was export compliance auditor. I would go overseas with the auditing team to keep an eye, to check out to make sure that they were obeying the rules as far as obeying U.S. export laws and that they had systems in place. So I would go over there and I'd ask everybody questions. I'd bother everybody. Then I'd write up a real nasty report. They loved to see me coming. Hi, I'm from corporate. I'm here to help you. Well, that was the idea, really, to keep them out of trouble, to find out all the bad little things that they were doing and get them to stop. Right? That's what the auditors do. The people that I used to go with, what a life they had, boy. They'd spend 3 or 4 weeks in Paris, then they'd hop on a plane and they'd go down to Rio de Janeiro for 3 or 4 weeks. Then they'd go home for 2 weeks, and then they'd hop on another plane, go to Bangkok for 3 or 4 weeks. And then they'd be done in Bangkok and they'd go to Tokyo for 3 or 4 weeks. Right? And then they go back home, and then they come to the United States for 3 or 4 weeks, or 8 weeks, 10 weeks, and they're always, always on the road, traveling. Okay? How would you like that job? Yes and no, right? If you're single and don't have any friends, it's fantastic. But if you have a family, it's terrible. But I just went with them once in a while, okay? Because they didn't have people who knew enough about what I would check on to do it themselves. So. The Fed conducts monetary policy, and that's certainly the main focus of what we're going to talk about. Monetary policy, managing geez, better talk faster. They intervene in foreign currency markets, attempts to keep the value of the dollar from changing, right? I told you that if the value of the dollar is going down, and what happens if we owe a lot of money like we do to a lot of people, we don't want that to happen because it's going to take us more of our money to pay those bills. So we go out and the Fed goes out and buys the money. Of course, we don't want it going up too much either because that makes our exports too expensive, and now our GDP will go down. So the Fed will go in and sell dollars and bring that down, okay? But generally speaking, they don't do a lot of that. Right? And the Fed is the lender of last resort. That's typically to banks, but unfortunately, recently, it became the lender of last resort to a number of entities like AIG, right? American Insurance Group. One of the entities responsible for the mess that we got ourselves into. Okay. All right. So that's the roles of the Fed. Just need to know that. I'm not going to ask you any questions on that. Okay. Now, I'm not going to give you any accounting problems either. Okay. I know some of you love accounting. You know how much accounting I've had? I had 1 semester in graduate school. That was enough. That's all I need to know. Debits, credits, got to balance at the bottom. All right? That is pretty much all you really need to know, unless you're going to be an accountant. Right? So, but I'm not going to ask you any accounting stuff. I didn't really like accounting for some reason, which is funny because I like numbers. I always liked math and stuff like that, but accounting just never really clicked for me for some reason. Statistics either. Statistics was horrible. All right? And calculus. Ugh. Even my second time going through calculus, I only got a B. At any rate, the Federal Reserve supervises banks and requires them, again, to have 10%, we'll say 10%, all right, just to make it simple, to retain 10% of all deposits on reserve, okay? Those are called required reserves. That's what you have to have. If you have more than that, the excess are called just that, excess reserves, okay? More than the bank is required to have by the regulations. Right? Now, in the past, banks, generally speaking, wanted to keep their excess reserves to a minimum. And the reason being was that they earned no interest. That has changed. The Federal Reserve now pays interest on required and excess reserves, all right? But that hasn't always been the case. So depending upon interest rates and the availability of alternative investments, the banks may keep extra cash, right? If I'm earning 2% from the Federal Reserve and the best I can earn on an investment outside is 1.5%, then I'll just hold on to the cash in the bank because I'm making more money than I would otherwise, all right? So how much excess reserves banks have today also is a function to some extent of the interest rates in the economy versus the interest rates that the Federal Reserve is paying on the deposits that the banks have, okay? Now, when the bank takes in $100,000, okay, they have to reserve $10,000, but they can lend the other $90,000 out, okay? So let's say that, the bank gets a deposit of $100,000 and it lends out $90,000. Whoever gets that loan puts it in their checking account in the bank. Now the bank's reserves have gone up by another $90,000. They can lend out $81,000 of that, okay? They have to hold on to $9,000, 10% on reserves. Whoever gets that $81,000 puts it in their checking account. Now the bank's reserves have increased by another $81,000. They have to hold on to $8,100, we'll just round it off, and now they can lend out another $73,000, okay? So far, let's say this was a loan by the bank to somebody else, they put it in the bank. So we have $100,000 lent, and then $90,000 as a result of that deposit, and then $81,000 as a result of that deposit, and then $73,000 as a result of that deposit, and then so on and so forth, okay? So if the bank lends out $100,000 to somebody, total lending and total payments to people, total purchases, will be many times more than that, okay? Because that money will be lent out over and over and over again. You lend me $100,000, I put it in the bank. Now the bank has $90,000 to lend out. They lend that out to somebody else. That person puts in the bank. Now the bank's got another $81,000, and so on and so forth. Okay? Does this look familiar to you? Yes, it's the multiplier effect. Okay? But this time it's called the money multiplier, and it has the same principle, same effect. Okay? It's 1 over the reserve ratio. Okay? So if we have a 10% reserve requirement, I mean, there are things that screw this up, make it much less than what it is. I don't need to know about that. Then the multiplier will be 10. So in other words, if the bank lends out $100,000, theoretically, total lending should reach $1 million. Total lending and spending should reach $1 million, 10 times that, because each person that gets a loan puts it in the bank. Now the bank can lend out a portion of it again. Now the reserve requirement has not changed since 1990. Okay? This is one of the tools that the Federal Reserve Bank doesn't use very much anymore at all. In the old days, they used it all the time because the other tools that they had were too ineffective. Okay? But now those tools are much more effective. And the Federal Reserve, when I say the bank, the Fed doesn't change this number very much anymore. And I'll tell you why. changing this number impacts the effectiveness of monetary policy, okay? That in order to stimulate the economy, the Federal Reserve will go out and buy bonds, okay? They will buy bonds that are existing in the hands of public and that are held by banks. When they buy a bond, you get $100,000, let's say. Okay, when they buy your bond back for $100,000, you go put that money in the bank, and the bank lends it out multiple times, and then total lending reaches $1 million, all right? Well, what happens if they raise the reserve requirement to 20%? What happens to the multiplier now? It's only 5. So if the Fed wants to stimulate the economy and buys a $100,000 bond, total spending and lending will only go up to $500,000, not $1 million, because of the reduced multiplier effect, okay? So they don't screw around with that very much anymore because it alters the effectiveness of the other policy tools, okay? Okay, which we'll talk about. Now, so you're not going to get any of these accounting questions, all right? But you will need to understand and probably maybe even calculate the money multiplier. But that's not too difficult, all right? I don't care about deposit insurance, okay, at all. So we can just skip right through that, all right? Let's see. We have a test. 11. We'll go for another 15 minutes, all right? And then we'll take a break for 20, and then we'll have our fun time. Okay, have fun time. Well, it's fun for me. All right. Yeah, we're going to talk about Chapter 16. I already talked a little bit about it, right? About the demand for money, why we want to hold money, okay? And the demand for money curve. Now, if we are in a recession, okay, we're back here, okay, at less than full employment, real GDP, the Fed wants to take action to shift aggregate demand back out and bring us back to equilibrium, full employment on the long run curve here, all right? So they have, right, fiscal policy focus would be on consumer spending, taxing by either increasing or decreasing taxes, and on government spending. In monetary policy, the primary focus is on business investment. That if we want to bring people back to work, to stimulate the economy, right, we've got to get business to invest more, to build more factories, to build more machines, to make more products, all right? Okay. So to stimulate business, remember what business depends upon? Business investment depends upon? Interest rates, exactly right. What the Fed wants to do to stimulate the economy is get interest rates to come down. Okay? And the way that they do that is to pump money into the economy. Very simply, if the Fed pumps money into the economy, there will be more money in the banks, right? Banks will find that they have too much cash at current interest rates to lend it all out, and to attract more borrowers, they will begin to lower their interest rates, okay? Right? To accomplish this, the Federal Reserve goes out and buys U.S. government bonds, treasury bonds, all right? Remember that in fiscal policy, if the Fed, if the government wants to spend more money or cut our taxes, to make that happen without, if they want to spend more money without reducing our income and spending, they can't take it away from us. They can't take what they need from us in the form of taxes. They have to go out and borrow it, okay? And the way they borrow it is they issue bonds. These things I talked to you about last time, these debt instruments, these are called debt instruments, debt. Okay? They issue debt. Lend me $1 million, I will pay you 7% interest. Every year I have your $1 million, okay? And then at the end of 8 years, or whatever the time frame might be, we, the government, will pay you back. Okay? Now, by the way, the safest investment, really, even though the government's credit rating, I don't like the credit rating companies. I think they're shady, all right? But the government credit rating went down a little bit, but I don't care. The safest investment you can make in the planet, the one where they have to offer the lowest interest rate, is a U.S. government bond. Okay? The U.S. government has never failed to pay its bonds. Chelsea failed. New York City failed. Argentina failed. Okay? But the U.S. government has never failed to pay its debts. It is the safest investment you can make. So for that reason, they can offer a fairly low interest rate compared to other alternatives. I mean, if they have to pay back your bond, if they have to pay back that debt, how can they get the money? Huh? Yeah, they could raise taxes on you if they want. Okay, that's one thing. Or they can sell more bonds. That's exactly what they do. They sell more bonds to get that money. Or there's a third alternative. Who owns the money printing presses? The government. So if they don't have the money, they could just print it. Okay? All right? And there is a relationship, by the way. I told you last time, I don't care about this crude quantity theory of money. The equation of exchange and the quantity theory of money. All right? We don't need to know that. The only thing you need to know is the first paragraph where it says monetary policy and inflation. Or is that the right one? The only thing you really need to know is that if money supply, if the amount of money in circulation grows too quickly, what's going to happen? Demand curve's going to shift out, and prices are going to rise. But if it grows at the same rate as production, meaning, yeah, demand is shifting out, but so is output, price level will stay the same, okay? So we get inflation typically when the growth in the money supply is greater than the growth in output, okay? We got more money chasing relatively fewer goods. So in order to raise funds to pay for its activities, its fiscal policy activities, the U.S. Treasury Department sells bonds, takes the money in, all right, and spends it on whatever they want. Okay? Now, and by the way, the Federal Reserve Bank of the United States owns billions upon billions of dollars of U.S. government bonds. U.S. government agencies buy these bonds issued by the Treasury, as well as banks, foreign governments, private citizens. Okay? When the Federal Reserve wants to alter the economy, either calm it down because we're in, we're out here, okay? We're in this inflationary thing, and the next thing that's going to happen, right, is that we're going to end up here and get more inflation, all right? That they want to push aggregate demand back in. So they will engage in a contractionary monetary policy. They will reduce the amount of money in circulation. If we're back here in a recession, then they want to engage in expansionary policy to pump more money into the economy. And what happens? When money flows into the economy, two things are going to happen. People are going to find that they have too much cash relative to other investments that they could make. I don't want all this cash sitting around. I'm going to go out and buy a new car. I'm going to buy something. I'm going to invest some of it, but I might also spend some money on goods and services. Okay? So if we have too much cash, we tend to spend part of it just to get rid of it, to change it into something else. So as money flows into the economy, spending by consumers should increase. Okay? The second thing that happens is, remember, there's two things we can do with our money: spend it or save it. As money flows into the economy, people put more money in the banks. Right? The supply of funds into the banks increases, and interest rates fall. As interest rates fall, more business investment happens. Okay? More business investment happens. As business invests more money, they hire more people, employment picks up. All right? This is the process. This is the chain of events. That policy, monetary policy, changes the amount of money in circulation, which in turn causes interest rates to fall or to rise, which in turn affects business investment, which in turn affects output and employment. All right? That's the chain of events that occurs. Now, in order to buy bonds, okay, well, I'm not getting bothered with that. Why bother? If the government wants to go out and pump money into the economy, what they do is go out and buy bonds, okay? Offer to buy bonds. To get, so what, you know, they talk about it in terms of supply. When they go out and buy bonds, they reduce the supply of bonds. When they go out and sell bonds, they increase the supply of bonds, all right? But really, the way I think of it is when they go out and they buy bonds, they increase the demand for bonds. And what's going to happen to the prices of bonds if the government goes out and says, I want to start buying your bonds? It's going to go up. In order to get you to sell the bond back to them, they have to offer a better deal than what you had, right? You paid $90,000 for it. I'll give you $92 if you sell it back to me, all right? So you can think of it either way. But when the Federal Reserve decides to go out and buy bonds, the result will be that bond prices will rise, all right? Okay. Now, so bond prices will increase. Bond prices will rise. What's going to happen to interest rates as the Federal Reserve buys bonds and gives everybody money? Interest rates are going to go down, okay? And this is an important principle, that bond prices and interest rates move in opposite directions, okay? That if interest rates go up in the economy, bond prices will fall. Okay? Here's why. I'll just do this and then we'll take a break. Okay? If I have a $1,000 bond that pays 5% interest, how much of a payment am I going to get every year? $50, okay? If interest rates rise to 10%, how much will this brand new $1,000 bond pay? $100. Would I be willing to spend $1,000 on your bond if I could buy another bond that's going to pay me $100 instead of your $50? Hell no. How much would I be willing to pay for this? Half. Only $500. Okay? At $500, an equivalent 10% interest would pay me $50. All right? So I would, in order to get that same 100, I would have to get 2 of these bonds. So I'd be willing to pay $500 for each one of these bonds. Okay? Interest rates and bond prices move in opposite directions. When the bond is first issued by the Treasury Department at a face value of $10,000, that's what it's worth. But over the course of time, before it, what they say, matures, that reaches its deadline, the price of that bond in the marketplace could be either above or below that, depending upon what happens to interest rates. If interest rates rise, then the price of that bond will fall. If interest rates fall, then the price of that bond in the marketplace will rise. Okay? I'm going to show you just one more thing to show that to you mathematically. Right? If I put $100 into an account and it pays 5% interest, how much will I have next year when I take it out? 105. Okay? Oops, not 100, 105. So I get my 100 back plus, okay, I get 100 times 0.05%, correct? All right? So I can actually I can simplify this as 100 times 1 plus 0.05, right? Okay? So today's value, I'm going to call this the present value times 1, I get my money back, plus the interest rate will be equal to the future value. All right with that so far? Okay. So I'll put this back up here. The present value times, actually, let's get rid of that x. Present value times 1. The present value, that's an x now. The present value times 1 plus the interest rate is equal to the future value. All right? Now, if I divide both sides by 1 plus the interest rate, these two cancel each other out, and the present value is equal to the future value divided by 1 plus the interest rate. Okay? What's going to happen to this if interest rate goes up? Anything that makes this number bigger makes that number smaller. Okay? So if interest rate goes up, the value of what you're holding today, bond, goes down. All right with that? Okay. All right. That's the bulk of what's going on. All right?